Nobel laureate Robert Shiller reveals a startling truth in narrative economics: behind every market boom and crash lies not just data, but something far more powerful: human stories. The economy doesn't run on spreadsheets, Shiller argues, it runs on the stories people tell themselves about money. While traditional economics obsesses over numbers, this groundbreaking work shows how viral narratives, from Bitcoin mania to housing bubble myths, actually dictate financial behavior in ways no statistic can predict. When fairy tales move billions. Consider how get-rich-quick stories fueled the 1920s stock frenzy, or how tales of too-big-to-fail banks distorted the 2008 crisis. As narrator Oliver Wyman observes, a single compelling narrative can do what 1,000 economic indicators cannot: make millions act against their own self-interest. These collective myths spread like epidemics, with early adopters, super-spreaders, giving them credibility before they infect mainstream thinking. The result? Markets that behave more like excited crowds than rational systems. The anatomy of financial contagions. Shiller identifies 7 traits that make economic narratives go viral. 1. Human interest: personal success stories beat abstract theories. 2. Moral polarization: framing winners versus villains. 3. Simplicity: easy-to-grasp concepts like the next Amazon. The Bitcoin boom perfectly illustrates this. A complex technology became irresistible when framed as digital gold that would make early adopters millionaires. Mastering the narrative economy. Understanding this phenomenon gives you an investor's edge. By recognizing when narratives diverge from fundamentals, like Tesla's valuation exceeding legacy automakers combined, you can avoid herd mentality. The most profitable skill in modern finance, suggests narrator Alex Vincent, is separating stories from substance. As Shiller proves, economies may be built on numbers, but they move on myths. The question is, will you be controlled by these stories, or learn to read them like the market's secret language? About the author, the visionary who redefined economics. Robert J. Shiller stands as one of the most influential economic thinkers of our time, having reshaped how we understand financial markets and human behavior. The Nobel Memorial Prize winner revolutionized economics by exposing how psychology drives markets in his groundbreaking bestseller Irrational Exuberance, a work that predicted both the dot-com bubble and housing crisis. As the Sterling Professor of Economics at Yale University, he bridges academic rigor and real-world relevance, regularly contributing his insights to the New York Times. Shiller's pioneering work in behavioral finance and narrative economics continues to challenge conventional wisdom, proving that numbers alone can't explain why markets rise and fall. Key Takeaway 1. How Stories Shape Our Economy, the Untold Power of Narrative Economics. You're flipping through channels and land on a financial news segment. A serious-looking economist starts talking: GDP growth, inflation rates, market volatility. It's a flurry of figures and jargon, almost as if the economy exists in a world entirely made of numbers. But here's the twist: while the data sounds definitive, it often leaves out something far more human: our emotions, beliefs, and the stories we tell each other. As Robert Shiller once said, narratives go viral just like a disease. They change economic behavior. Behind every major economic shift lies a narrative, a collective story that moves people more powerfully than numbers ever could. In the realm of narrative economics, the focus shifts from cold calculations to the warm-blooded pulse of human behavior. Traditional economists rarely acknowledge the messy, emotional drivers behind financial decisions. But narratives, shared stories or beliefs, can ripple through society and influence decisions en masse. Unlike a simple tale with a beginning and end, these narratives are ongoing myths we live by. They don't just describe the economy, they shape it. Whether it's the belief in the American dream or fear of an impending crash, these collective stories steer market behaviors just as much as interest rates do. Consider the tale of the shrewd businessman, a powerful American narrative. Donald Trump tapped into this during his presidential campaign. Whether or not he fit the mold didn't matter. What mattered was that he aligned himself with the story, the tough negotiator, the deal maker, the billionaire who could win for the country. This narrative struck a deep chord with voters, transcending traditional policy debates. It wasn't Trump the man who got elected, it was Trump the myth, elevated by a story that had been woven into American culture for decades. History offers another striking example: the 1929 stock market crash. Leading up to it, America was swept up in tales of ordinary people turning small investments into fortunes. These viral success stories fed a buying frenzy. People poured savings into stocks, dreaming of riches. But when the story faltered, panic set in. The crash wasn't just a result of bad economics, it was the collapse of a collective fantasy. Just as a narrative inflated the market, its unraveling brought it crashing down. The story shifted, and so did the economy. One economist who understood this long before it became mainstream was John Maynard Keynes. In his 1919 book The Economic Consequences of the Peace, Keynes predicted Germany's future unrest not from a spreadsheet, but by reading the national mood. He knew that imposing crushing reparations after World War I would breed resentment and instability. No graph could have shown that, but a deep understanding of public sentiment could. As Keynes famously put it, the ideas of economists, both when they are right and when they are wrong, are more powerful than is commonly understood. Narrative economics builds on that insight. To truly grasp the economy, we must first listen to the stories people believe. Key takeaway 2: How Bitcoin became a global phenomenon, the power of story over technology. In late 2008, a mysterious figure named Satoshi Nakamoto emerged from the shadows of the internet and dropped a digital bombshell, a white paper titled Bitcoin, a peer-to-peer electronic cash system. The post sent ripples through online communities, sparking curiosity and excitement. Nakamoto's identity remains unknown to this day, but their creation, Bitcoin, has ignited a financial revolution. While the invention is built on a foundation of brilliant cryptographic theory, it wasn't the complex math that drew in millions. It was the narrative, the compelling, viral story of decentralization, disruption, and digital liberation. As with many major economic movements, it's not the spreadsheet that captures the imagination, it's the myth. For most Bitcoin investors, the attraction isn't rooted in technical understanding. Ask about Merkle trees or elliptical curve digital signatures, and you're likely to get a shrug. What they do know is that Bitcoin represents something different, something bold. It's not printed by a central bank, doesn't bear the image of a monarch or president, and isn't bound by traditional borders. It's wrapped in a vision of freedom and innovation, offering a dramatic alternative to the status quo. As economist Robert Shiller noted, the human brain is built to remember stories, not statistics. And Bitcoin is a masterclass in modern storytelling. At its core, the Bitcoin narrative is a promise, a stake in a futuristic world. Investors see themselves as early adopters of a coming shift, members of a savvy elite who understand where the world is heading. It's a ticket to relevance in the digital age. Another powerful thread in this story is rebellion. Bitcoin is often seen as a financial weapon against bloated governments and corrupt banks. It's not just currency, it's a form of resistance. Add to that its stateless, borderless nature, and Bitcoin becomes a symbol of global citizenship, an economic identity for those who see themselves as forward-thinking and free. Strip away the mystery, the idealism, and the narrative, and Bitcoin becomes just another tech innovation, brilliant, but possibly forgettable. It's the captivating story that fuels its viral rise, a hidden founder, a digital revolution, a new economic frontier. Bitcoin isn't merely a tool, it's a belief system, a modern myth that rallies millions. Its journey proves a profound point: in the world of money, the most powerful currency might just be the stories we choose to believe. Key takeaway 3: How economic narratives spread like viruses, lessons from epidemiology. Imagine walking through a university campus. You pass by departments of literature, economics, anthropology, and physics, each a silo of deep, specialized knowledge. While their insights are powerful, this intense focus can become a limitation. What if, instead of working in isolation, these disciplines learn from one another? In the case of economics, there's a surprising field it could borrow wisdom from: epidemiology. That's right, the study of epidemics. At first glance, viruses and financial systems may seem worlds apart. But when you look closer, you'll see that the way stories spread in economics is eerily similar to the way diseases move through populations. Just as viruses have infection rates and death rates, narratives too have cycles of contagion and decline. Think about a viral disease like COVID-19 or Ebola. In its early stages, the number of new infections outpaces those recovering or dying, leading to a rapid rise. But eventually, that curve bends. Recovery and death begin to outnumber new infections, and the epidemic wanes. This same model applies to what economists are now calling narrative epidemics. Instead of physical transmission, the contagion happens through conversation, media, and social platforms. Stories spread from one person to another, picking up momentum with every tweet, news segment, or dinner table chat. Then comes the inevitable slowdown, not due to immunity, but to forgetfulness and fatigue. People stop sharing, stop caring, and the story, no matter how powerful it once was, fades. One of the most vivid examples of this phenomenon is the story of Bitcoin. If you track the mentions of Bitcoin in global media over the past decade, you'll see a pattern that mirrors a pandemic curve. There was a steady build-up around 2013, a massive spike in 2018, and then a decline, not into extinction, but into dormancy, with occasional secondary surges, just like aftershocks in a viral outbreak. Bitcoin didn't just behave like a market asset, it behaved like a story virus. And just like a flu or a coronavirus, its narrative went through phases of explosive growth, saturation, and eventual decline in attention. It's not just the price that fluctuated, public interest followed the same epidemiological rhythm. So why does this matter? Because understanding narrative epidemics can help us better predict and respond to shifts in the economy and public sentiment. Just as health officials model outbreaks to prepare hospitals and policy, economists and leaders can model story spread to anticipate financial manias, political movements, or even social trends. Sometimes, the most powerful stories don't spread in isolation, they go viral when they collide with other narratives already in circulation. By seeing these patterns early, we gain the power not just to react, but to prepare. In a world driven by the stories we believe, recognizing the shape of a narrative epidemic could be the ultimate economic advantage. Key takeaway for the hidden web of economic beliefs: how narratives reinforce each other. Imagine your next-door neighbor as a solitary, grumpy figure who once installed spikes on their fence to keep cats away. You never gave it much thought, until a cat goes missing in the neighborhood. Suddenly, that one detail about your neighbor takes on new meaning. You begin to reframe their every action through a new lens: they must hate cats. Whether or not it's fair, that single narrative takes hold because it connects with other details in your mind. This is how stories work, not in isolation, but as part of a broader constellation. The human brain naturally links narratives together, and in the world of economics, this behavior profoundly shapes public belief and policy. A perfect illustration of this is the rise of the Laffer curve, a once obscure economic idea introduced by economist Arthur Laffer. It's a simple, upside-down U-shaped diagram suggesting that beyond a certain point, raising taxes actually reduces government revenue. But it wasn't the logic of the theory alone that made it famous. The narrative took off after a now legendary dinner in 1974, where Laffer sketched the curve on a napkin for Republican figures Donald Rumsfeld and Dick Cheney. That image, the economist urgently drawing his revolutionary idea during dinner, made the concept memorable. And more importantly, it linked to a larger story that was already brewing in people's minds: the idea that government is bloated and inefficient. This narrative constellation deepened in the 1980s with the rise of Ronald Reagan and Margaret Thatcher. Their political messaging leaned heavily on skepticism of government interference, and the Laffer curve fit right into that frame. It became more than a tax theory, it became a symbol of economic freedom. At the same time, Ayn Rand's novel Atlas Shrugged was gaining traction, telling the story of innovators rebelling against a stifling government. These weren't separate narratives, they were interconnected, reinforcing a collective belief that government regulation was the enemy of progress. Each story gave the others more weight, pulling individual beliefs into a gravitational system of shared ideology. The takeaway? No narrative exists in a vacuum. Every idea we adopt is influenced by a web of supporting stories. Understanding a single economic belief without considering the ecosystem around it is like trying to navigate by a single star in the night sky. You'll miss the full constellation. As we examine the economic ideas that shape our world, it's vital to look beyond the surface. One powerful story may capture our attention, but it's the invisible network of linked narratives that gives it momentum, credibility, and cultural staying power. Key takeaway 5: How vivid stories shape the economy, the secret power behind economic resilience. Human beings are wired for stories. As philosopher Jean-Paul Sartre once said, "A man is always a teller of tales." He sees everything that happens to him through them. Our minds naturally seek out meaning through narrative, piecing together events into stories that help us understand the world. Whether it's in politics, personal life, or economics, we instinctively look for a thread, a cause, a consequence, a character. But to construct these mental tales, we need more than just facts or statistics. We need vivid, concrete details that bring a narrative to life. To understand the power of these details, consider a 1985 study by cognitive psychologists Brad E. Bell and Elizabeth F. Loftus. Participants were asked to play the role of jurors in fictional court cases. Some versions of the cases included colorful, specific details, like a bowl of guacamole spilled on a white shag carpet during the crime, while others did not. The results were stunning. Even though the spilled guacamole had no legal relevance, its vivid imagery led to more guilty verdicts. Why? Because the detail helped participants visualize the crime, forming a more memorable and convincing story. This psychological trick doesn't just affect juries, it shapes economic thinking too. In the world of economics, these narrative hooks often play an outsized role in shaping public reaction. Consider the aftermath of the September 11 terrorist attacks. At the time, the U.S. was already in a recession, and the immediate destruction of the World Trade Center and the attack on the Pentagon seemed to confirm an economic doomsday. Experts warned of prolonged instability. All the data pointed toward deepening decline. But something unexpected happened. By November, the recession was declared over. The economy had bounced back far quicker than anticipated. Why? Because amid the trauma, a new narrative began to form. Americans had just witnessed a powerful, emotional event. The symbolic destruction of key national landmarks stirred deep feelings. But rather than dwell in despair, President George W. Bush gave a speech that rewrote the narrative. He urged Americans not to retreat in fear, but to engage with the country again. "Fly and enjoy America's great destination spots," he said. "Go down to Disney World in Florida." It was an invitation to reclaim normalcy, and it worked. That message, combined with the vivid imagery of resilience, sparked a counter-narrative that fueled economic revival. People didn't just respond to charts or forecasts, they responded to a story. The vivid scenes of tragedy were met with equally vivid scenes of perseverance. In response, businesses regained momentum, consumers resumed spending, and the national mood shifted. The economy didn't just recover because of policy, it recovered because people believed in a new story. That belief, sparked by imagery and reinforced by leadership, became its own economic force. So when we talk about economic change, we can't just talk about interest rates, labor markets, or inflation. We must also look at the stories people tell, stories driven by emotion, grounded in vivid detail, and powerful enough to steer the course of entire economies. Understanding this doesn't just help us analyze the past. It helps us prepare for the future, because every economy, at its core, runs on belief. Key takeaway 6. The timeless tug-of-war in economics, panic versus confidence and the power of perennial narratives. Economic booms and busts often feel unpredictable, but there's a deeper rhythm beneath the surface, one shaped by the timeless tension between panic and confidence. This isn't just a matter of numbers and interest rates. It's a story we've been telling ourselves for centuries, one that plays out again and again. Confidence is the invisible currency that fuels economies, confidence in banks, in businesses, and most crucially, in one another. As author Christopher Booker once categorized all storytelling into 7 basic plots like rags to riches or overcoming the monster, economics, too, follows recurring narrative arcs. The story of panic versus confidence is one of the oldest, and still one of the most powerful. The United States offers one of the earliest and clearest examples of this narrative cycle. In 1857, just before the Civil War, a financial panic gripped the nation, triggering widespread fear and economic downturn. This concept of panic gained even more traction after the Panic of 1907, when the famous financier J.P. Morgan used his own wealth to rescue the banking system. The drama of the moment, one man saving the economy, cemented the word panic in the financial lexicon. Yet, as much as panic is feared, confidence has always been the antidote. President Calvin Coolidge, in the roaring yet unstable 1920s, made it his mission to radiate optimism about the economy, even when the facts behind the scenes told a different story. His goal? To keep the public's confidence intact and avoid triggering mass fear. This pattern resurfaced powerfully during the 2008 financial crisis. Echoes of past panics were unmistakable. News headlines, political rhetoric, and public sentiment all seemed to draw from the same familiar script, a narrative of looming collapse fueled by historical memory. This wasn't just history repeating itself, it was a case of economic storytelling influencing real behavior. People weren't only responding to the numbers, they were responding to the story of 1929, the Great Depression, and every panic that came before. What began as a credit crisis became an emotional contagion, spread through old narratives dressed in modern clothes. Alongside panic, another familiar economic tale returned, the crash. Before 1929, the term crash referred to thunder or dramatic music, not financial ruin. But after the devastating collapse of the stock market that year, the word took on a whole new meaning. And during the Great Recession of 2007 to 2009, that same language re-emerged. Journalists, economists, and everyday citizens described what was happening as a crash, echoing the drama of nearly a century earlier. And just like that, the narrative loop closed once more. The storyline of reckless speculation followed by sudden ruin replayed itself, not just in headlines, but in how people acted, spent, invested, and feared. These economic stories, panic and crash, confidence and recovery, aren't just linguistic habits. They are deeply embedded in the collective psyche. They guide public emotion, shape government response, and influence the markets more than we often acknowledge. Like ancient myths that morph but never vanish, these narratives evolve with each generation, retaining just enough familiarity to feel inevitable. And unless we become conscious of them, we risk reacting not to facts, but to shadows of stories from the past. To understand today's economy, we must look beyond data and policy. We need to recognize that what we're often experiencing isn't entirely new, it's a continuation of economic folklore, passed down through time, adapting to each new crisis. When we tune into these patterns, we gain a new lens through which to interpret the world, not just as a web of transactions, but as a living, breathing story still unfolding. Key Takeaway 7: How Memories Shape Markets, the Shifting Power of Economic Narratives Over Time. We all carry personal memories that evolve over time. A once-forgotten road trip, a clumsy fall at a bowling alley, or a chaotic holiday can resurface years later with a different emotional tone. Suddenly that awkward or painful moment becomes part of a cherished story. This same phenomenon plays out on a much larger scale in economics. Just as our personal recollections morph, collective memories of economic events shift too, subtly altering how we interpret and respond to them. The key message here is that the economic impact of narratives changes with time. The past may be fixed, but the story we tell about it is not. Take the infamous stock market crash of October 19, 1987, still the largest single-day percentage drop in market history. Even today, its legacy haunts investors and commentators alike. Every anniversary revives a flurry of articles, think pieces, and speculation about whether such a crash could happen again. But what often gets lost in the retelling is the specific cause of the event: portfolio insurance. This computerized trading strategy, designed to minimize losses, inadvertently led to mass sell-offs as markets fell, intensifying the panic. It was a very particular set of circumstances, not a timeless market flaw. Yet, divorced from that context, the crash of '87 continues to stir anxiety, more as a ghost story than a useful guide. The same shift in narrative can be seen when comparing the market responses to World War I and World War II. In 1914, at the outbreak of World War I, panic ruled the financial world. European investors scrambled to extract gold from the US, despite the fact that America wasn't even involved in the war at that point. This led to steep market declines, driven largely by fear and uncertainty. But fast forward to the start of World War II in 1939, and the story had changed. Instead of panic, markets rallied. The S&P 500 jumped 9.6% in a single day. Why the stark contrast? Because between the wars, a new narrative took hold, that those who kept faith in the market during World War I emerged wealthier on the other side. This dramatic transformation in public memory reshaped investor behavior. By the time World War II broke out, the trauma of the First War had been reinterpreted as a lesson in long-term resilience and reward. Investors acted not out of fear, but out of belief in a story they had retold and reshaped over decades. This illustrates a vital point: economic decisions are not always made based on objective analysis, they are filtered through evolving stories about what the past means. Recognizing this fluidity in narrative is crucial, because it means that today's decisions are often being made with yesterday's myths in mind. As we've learned, it's not just the data that drives economies, it's the way we remember the data. Key Takeaway 8. How Memories Shape Markets, the Shifting Power of Economic Narratives Over Time. We all carry personal memories that evolve over time. A once-forgotten road trip, a clumsy fall at a bowling alley, or a chaotic holiday can resurface years later with a different emotional tone. Suddenly that awkward or painful moment becomes part of a cherished story. This same phenomenon plays out on a much larger scale in economics. Just as our personal recollections morph, collective memories of economic events shift too, subtly altering how we interpret and respond to them. The key message here is that the economic impact of narratives changes with time. The past may be fixed, but the story we tell about it is not. Take the infamous stock market crash of October 19, 1987, still the largest single-day percentage drop in market history. Even today, its legacy haunts investors and commentators alike. Every anniversary revives a flurry of articles, think pieces, and speculation about whether such a crash could happen again. But what often gets lost in the retelling is the specific cause of the event: portfolio insurance. This computerized trading strategy, designed to minimize losses, inadvertently led to mass sell-offs as markets fell, intensifying the panic. It was a very particular set of circumstances, not a timeless market flaw. Yet, divorced from that context, the crash of '87 continues to stir anxiety, more as a ghost story than a useful guide. The same shift in narrative can be seen when comparing the market responses to World War I and World War II. In 1914, at the outbreak of World War I, panic ruled the financial world. European investors scrambled to extract gold from the US, despite the fact that America wasn't even involved in the war at that point. This led to steep market declines, driven largely by fear and uncertainty. But fast forward to the start of World War II in 1939, and the story had changed. Instead of panic, markets rallied. The S&P 500 jumped 9.6% in a single day. Why the stark contrast? Because between the wars, a new narrative took hold, that those who kept faith in the market during World War I emerged wealthier on the other side. This dramatic transformation in public memory reshaped investor behavior. By the time World War II broke out, the trauma of the First War had been reinterpreted as a lesson in long-term resilience and reward. Investors acted not out of fear, but out of belief in a story they had retold and reshaped over decades. This illustrates a vital point: economic decisions are not always made based on objective analysis, they are filtered through evolving stories about what the past means. Recognizing this fluidity in narrative is crucial, because it means that today's decisions are often being made with yesterday's myths in mind. As we've learned, it's not just the data that drives economies, it's the way we remember the data. In summary, the book goes deep into the stories that move markets, a powerful summary of narrative economics by Robert J. Shiller. Imagine a world where numbers don't rule the economy, where stories do. Where the fate of markets, national wealth, and global crises hinge not just on GDP or inflation, but on the tales people believe. In narrative economics, Nobel Prize-winning economist Robert J. Shiller unveils a compelling truth: economic events are not just shaped by charts and statistics, they are driven by the contagious power of storytelling. Just as viruses spread from person to person, so do narratives, shaping mass behavior and ultimately altering the course of history. At the heart of Shiller's thesis is the idea that economic narratives, stories people tell about confidence, panic, innovation, and decline, play a vital role in driving real-world outcomes. These narratives often begin as simple anecdotes or popular beliefs, but once they reach a tipping point, they can trigger market booms, recessions, or revolutions. Take Bitcoin, for instance. Most investors aren't obsessed with its technical framework, they're drawn to the story of decentralization, of rebellion against financial giants. The human brain is built to think in terms of narratives, Shiller reminds us, not equations. Shiller draws parallels between economics and epidemiology, showing how narratives spread like epidemics. Like a virus, a good story infects minds quickly and can fade just as fast when interest wanes. Some narratives rise and fall with dramatic flair, like the idea of a housing market that never crashes, which helped inflate the 2008 bubble. Others, like the enduring tale of the shrewd businessman, helped launch political careers. These stories don't just reflect reality, they shape it, by altering how people act in markets, elections, and everyday financial decisions. The book takes us on a journey through history, exploring how recurring narratives, like panic versus confidence, boom and crash, or the evils of taxation, repeat across generations. Shiller shows that just as Christopher Booker once said, all stories follow basic plots, economic tales follow their own scripts. From the Panic of 1857 to the Great Recession of 2008, the emotional forces behind these events were powered less by hard data and more by the public's belief in a shared storyline. When we understand these perennial plots, we begin to understand the rhythms of our economies. Equally fascinating is how narratives change over time. What began as widespread fear in one era can become an inspiring tale in another. The stock market crash of 1987, for example, is remembered with dread today, but at the time, it was intensified by a specific technological glitch, portfolio insurance. Yet that detail fades with memory. Likewise, the economic narrative surrounding World War I evolved dramatically by the time World War II began. Investors, once panicked, now held firm, because the story had changed. Shiller argues that narratives are not only powerful, they are also mutable. By acknowledging that our financial systems are influenced by these emotional, often irrational forces, Shiller calls for economists to embrace a broader, more human-centered approach. He encourages the blending of economics with psychology, history, and even literature, to track, measure, and predict the movements of narratives themselves. This revolutionary perspective doesn't discard numbers, it gives them context. And it empowers us to respond better to crises by understanding not just what's happening, but what stories people believe are happening. So if you've ever wondered why markets rise in euphoria or crumble in fear, the answer might not lie in a spreadsheet, but in a story. Narrative economics reminds us that we are all storytellers, and the tales we tell shape the future we live in. As Shiller writes, we need to incorporate an understanding of changing narratives into our economic theories. Thank you for coming back and investing your time in this summary, it means the world. And if no one has told you lately, let me be the one to say, you are loved, worthy, and fully capable of achieving greatness. Especially when you choose to feed your mind with empowering books like this. Keep turning pages, keep chasing stories, and remember, the most powerful narrative is the one you write for yourself.